Alright guys, so in today's video, we're actually going to be talking about the New York macro model. And we're going to talk about just using one macro, which is the 950 to 1010 model. Now, what we're going to do, we're going to backtest, right? And all we're going to do is we're going to map out the 950 to 1010 segment and see how many times in this macro do we have opportunities to enter trades. That's all we're going to look for, right? Now, if you look at yesterday's price action, just so I can make this relevant, have a look on the 3-minute time frame, right? This is a very typical unicorn entry model. So on this particular day, you can see you've got this bullish gap. We respect that. We've also got a breaker block here, accumulation, manipulation, distribution. That now becomes obviously your power of 3, but it also becomes something else, guys. It also becomes a unicorn model and a good opportunity to go long. So what we're going to do, we're going to backtest this for every single day, right? Every single day as far as we can go. And then we'll make a judgment on what we do from there. So that there is our first day. You can see how that works out. On the 1 minute, that's what it looks like. And on the 1 minute time frame, you've actually got, look what happens here. You generate all this low resistance liquidity right there. See that? That's all low resistance liquidity, right? So that's the first day. Let's go back to the previous week. And we're just going to map out these macros just to see what price does in these macros, right? Here's the next one from 950 right until 1010. Now have a look. Notice how these macros often, not always, but often act as pivot points. So on this particular day, yeah, you might have gone long from this bullish gap. You probably would have been stopped at break even, but have a bit of a look what happens here, right? In this macro, we come up, we raid liquidity on the buy side. So we raid this liquidity. And then look what happens here. We have a push down. We leave this gap as a breakaway gap. That indicates extremely bearish price action. And I'd be curious to see what this looks like on a slightly higher time frame. Let's say the 2 minute or even a slightly lower time frame. Have a look at this, right? This inversion fair value gap now becomes your entry to go short. Right? That now becomes your entry to go short. If we just play price out now, let's have a look at what price does. Do we get our 1 to 2 risk to reward? That's the question, because a lot of people, that's the magic number. The magic number is like a 1 to 2. Well, let's have a look, right? Let's have a look. You go short when price trades back in. You put your stop above that high. You target a 1 to 2 risk to reward. Do you get it? Let's have a look. Let's see. In this particular case, you get stopped at break even, right? So in this particular case, if you went for a fixed 1 to 2, you get stopped at break even there. Now this example is good because it illustrates a few things, right? It's important, it's really important to take partials. Really important, because what you might do, you might be waiting for price to come to this low. What I've noticed play out time and time again is that price may come to the bodies, which is where a lot of the volume will sit, but not to the actual low. So what I've been kind of practicing lately is either taking a partial or the full profits out at that level, right? For me personally here, there'd probably be a few partials that would be taken at this point. So, you know, that's a 1 to 1.72. Potentially this big bullish gap, somewhere here there'd be a partial, and then maybe there'd be a partial here. Maybe there's one contract left, and then obviously we get stopped out at break even. So this is just to illustrate, right, that the macros are often going to do something important, and it's up to you how you manage your risk. Like, I can't tell you how to do that, but if you want to go for a fixed 1 to 2, it's not always going to work out. Partials do pay. So that's the second day that we've had a look at. Let's now have a look at this day. And again, let's have a look from 950 to 1010, right? So let's have a look here. 950, let's have a look. Roughly is about here. To 1010, where's 1010? Okay, 1010 is here. Cool. So 950 to 1010, we come down, we raid liquidity, which is great. And then I believe there's a bullish gap right here. There you go. Right, that's your bullish gap. What would you do here? How could you use this macro to execute a potential trade? Well, you could go for a long position right from here. Stop below this body's wick. What do you target? Well, if you're targeting a 1 to 2, you do get that, but you could take partials if you need to. So again, macros are really important. They're not always going to be working, but when they do, it gives you high probability trades. So how do you know if a macro is going to be good or not might be a question. You've got to make sure that there's raids of liquidity, and you've got to make sure there's a clear draw on liquidity too. You can't just take any macro and expect it's going to work. There has to be something happening that's important. That's really important to know, right? So for example here, where is this? 950, look at this, 950 to 1010. You tell me that that macro is good. It's not. So this is an accumulation macro. There's no entry in that macro. So what would happen on this day if you're using that macro strategy? You have to come back, right? You have to come back, or you just leave it, because on this particular day, there's nothing going on here, right? There's nothing going on during the AM session macros, right? For the PM session macros, potentially, but AM session, there's nonsense, right? There's not much going on there. So what I'm trying to do, I'm trying to illustrate that some days it's not always going to work out, but when it does, it's high probability. So let's have a look here. Here's the next one. 950. And notice how a lot of these times, this is when a reversal happens, guys. You know why? Is because 930 to 1010 is sometimes the Judas swing. Look at this. 930 to 1010, there's your Judas swing. That Judas swing raised liquidity. You've got all this buy side generated. What's this macro do? It frames the trade for you guys. It frames the trade. It creates this inversion fair value gap, which provides you an entry to go long later on the session. So this is how you use macros to obviously benefit your trading. And then as we work our way up, we just tap onto this order block, right? And then we continue. So again, 950 to 1010, not always, but a lot of the time, it'll be a pivotal point in the market, right? Something important should happen, and you're looking either for a rate of liquidity or some kind of entry. So let's have a look here, 950 to 1010. What happens here? This particular macro, all we're doing is we're returning into this big bullish gap. That, yeah, could be an entry, but for me, there's no reversal there to take advantage of. The reversal comes slightly after, which actually happens in the next macro. So again, this video is just focused purely on this 950 to 1010 macro, just to simplify it, because there's going to be a macro at different points in time, right? So we want to take advantage of that particular macro. Next macro, let's have a look. So let's go 950 to 1010. So that's 950 here. 1010 is there, right? We raid this sell side liquidity right here. So we raid that sell side liquidity. We don't really have any entries here though. That's the issue, right? Now, sometimes if you can't see anything in the 1 minute, maybe the 2 minute has something. So we're on the 2 minute now, sorry. So let's go back to the 1 minute. So the 1 minute actually has something here for us that's important. We've got an inversion fair value gap right here and a big bullish gap right there. Now, you can decide how you enter, right? That's going to be up to the operator. So if we play that out, let's just see what happens here. We go obviously to a peak and then we end up pushing down anyway. But let's just see what happens here, right? Let's see kind of what risk to reward you could yield with a particular trade like this. So let's assume like you went long from this inversion. As soon as we closed, stop below that low. Do you get a 1 to 2? Yes. If you went from this bullish gap, stop below the inversion, do you get a 1 to 2? Yes, right? So either way, you still get that risk to reward. So hopefully this is opening your eyes, guys, that macros and a combination of that and silver bullet are going to frame high probability trades for you guys. You know what I mean? Any day you can come there and you can find these setups. You can find these setups. So here's another one for you, right? Again, have a look, back test this, forward test this for yourself. But I already know that's 950. I already know. Without even looking at the times, right? 950 is there. And where's 1010? Right there. Rate of liquidity. Inversion fair value gap right here. And also one below that too. You take a long position, stop below that low. Just like this. And then we push price up. Right? Then we push price up. And then we get a 1 to 2 risk to reward. So just to recap what we're talking about, we're talking about this time frame, 9:50 in the morning to 10:10 in the morning. That is classed as a macro, right? So in terms of some points, number one, the macro should do something important. If it accumulates, then leave it, right? So if the macro accumulates, then leave it, right? If we have a clear target, then that's going to be a tick. That's what we need. And we rely on time. Time first, then price. Time being the macro, price being the entry model that we might use, right? So again, all I'm doing here is I'm just going back in time. And it's not always going to work out, right? You'll see probably examples here where it doesn't always work out. But let's just have a look. Let's keep going, right? So 950 is here, roughly. And then 1010 is somewhere here. In this example, again, I'm just on the 1 minute chart, right? I'm not even going through higher time analysis, but if you pair this with high time frame analysis, that can also give you more confidence. We create an inversion fair value gap here, and we trade back down into it. That's your opportunity to go long. Let's see if you get a 1 to 2. If you put it below this low, you wouldn't get a 1 to 2. You might get a partial though. If you put it below the bodies, you wouldn't. So this might be a situation where it's a partial and then break even, right? So you're not always going to get a massive 1 to 2, right? That's important to keep in mind. Depends on the operator, being yourselves, and how you manage your risk. Let's have a look. Here's another little example. So let's have a look. 950 to 1010. So where's 950? 950 is here. 1010 is somewhere here. We raid liquidity actually before the macro. The macro creates this massive balanced price range. And then we have opportunities to enter long. Again, how you enter, what you enter from is going to be up to you. It could be from a bullish gap like I've shown you. It could be from an inversion fair value gap. It all depends on your entry criteria. Here you got a bullish gap and an order block, right? And you can see we've got equal highs here. That's your drawn liquidity. So I thought I'd make this video, guys, just to illustrate the fact that you can build your own model based on macros. You can build it based on silver bullet. Use time first, right? Use time first. So hopefully you guys have got something from this. If you have, let me know in the comments below. If you got any questions about this, just send me a message. Either if you're on my Discord, send that to me there. If you just follow me on YouTube, then leave a comment in the description. And until next time, guys, I'll talk to you then.